Hey, it's Soleil, and today we're talking about additional covered call strategies specifically related to compounding interest. So, just I'll quickly recap. Before we looked at getting 1.01, 1% interest per week, 52 weeks a year, selling covered calls every Friday. And if you reinvest all of your profits, you get 1.67 times your starting amount at the end of the year. However, what if we could do 1% three times a week? There's 52 trading days. Let's make it 150 trading days a year if we were able to do that three times a week. And if we still got 1%, that would be to the 152nd power. And you would 4x your money every year. Is that possible? There are a few stocks that actually have 3 expiration dates per week. IWM being one of them. I'm going to start with that one. I think the premium is a little higher with IWM than SPY, which are the two that I have traded. And if you sell puts at the 175 strike, it's trading at 175.38 right now. You can just about get 1%. So you'd probably have to sell this for 169 to get it to fill. 1% would be 1.75, so it's just under a percent. If you bought 100 shares and sold a covered call for Monday, and keep in mind, there's only one trading day between today, which is Friday, and Monday. So when you sell these covered calls on Monday for Wednesday, it's actually 2 trading days. And Wednesday to Friday, there's 2 trading days. So the premium is a little bit higher. Same thing if you bought 100 shares and sold at the money for 176, you're going to get just under 1%. But even, let's just say that you get a 0.5%. Let's take a look what that would be. So 1.005 exponent, 150 times a year, you still double your money. So even if you were only able to get half of this, even if you're only able to get 75 cents times 100, now granted, not everyone has $17,600 to buy 100 shares of IWM, but this is just a maximal strategy for folks who do. And same deal. If you just want to trade IWM, you could buy 100 shares, sell a covered call, get your 150 bucks. Next week, you could buy another share of IWM. Same strategies as before. It's just that since there are so many trading days, March 13th, 15th, and 17th are the 3 expiration dates for next week. Now, granted, there's going to be a little bit of friction in the system. You're not going to be able to necessarily close these out for nothing. So let's say we sold a covered call last Wednesday. It's expiring today. And let's just say that the price was 175 and it's still 175. Like the price didn't change at all. So if we wanted to close that out right now, we'd actually have to buy it back for 62. So let's say we sold it for 160 or 170. We're only going to be able to collect about half of it when we roll it. So keep that in mind. This strategy is, we're looking at hypothetical numbers. If you could sell the covered call, reinvest all the profits, not have to buy it back for anything. So more reasonable would probably be this one, the 0.5% 3 times a week, and you still double your money in 1 year with something like this. Let's take a look at SPY. Trade SPY options, sell puts for Monday. And I look at IWM first because, and if you have 25 grand in your account, which means you can do pattern day trading, that lets you trade IWM. Same for SPY, but if you have 25,000 and you don't have 38,000, you can do this strategy with IWM. So yeah, so you're going to get a little bit less. Let's see, selling a put, 1% of 385 would be $3.85. You're only able to get 262. You bought 100 shares and sold a covered call at the money. You get 386. So yeah, about, I don't know, a little more than 0.5%. Um, I believe SPY does pay dividends, so there's another little benefit. I haven't really worked out the cost benefit to that, but every time you get paid a dividend, you could use that money to buy more shares. Um, yeah, this is doable. Uh, I've used it and had success with it. The uh, of course, this is just for entertainment. I'm not a financial advisor, so I can't advise you to in any way. But yeah, I've done this, and I would suggest if you're worried about maximizing, you want to trade on like a Robinhood or somebody who has no fees, especially when you're going to be making 3 trades per week just on the same 100 shares. And if you're getting charged $1 or $2 per trade, that's going to eat up into your profits. And when you're making, um, it doesn't seem like much, but if you're getting paid $175 and you have to pay one of those dollars, you're already sacrificing half to 1% of your profit. Actually, yeah, 0.5% ish. So, um, some of the other, I do trade on Robinhood, but I have most of my trading on Tastyworks, and I do pay some fees on Tastyworks, but uh, I like some of their, I guess, tools, being able to search for earnings days, things like that, which brings up another good point. I would not carry a covered call over earnings if there's a potential for a huge gap up. Especially, probably doesn't happen too much with IWM and SPY since they're ETFs. So one company's earnings isn't going to move the needle too much. But if you're trading something that's volatile, like Tesla, maybe they're expecting a certain amount of earnings, like what happened on the most recent earnings, and it wasn't as bad as expected or was better than expected, and then there's a huge gap up. If you're selling a covered call at the money, trying to get the most premium possible, and the price gaps up to 180 or 200 or whatever, you're going to miss out on all of that. So that's only 4 days out of the year for companies that have earnings that you would not carry this covered call. So it's gonna put a very small dent in any of the premium that you can earn. And you don't necessarily have to be as greedy with it as well. If you want to allow for, let's say for IWM, if you want to allow for 1% for the price to move in 2 days, so you'd have to go up to like the 180 strike. That's only about 1/3%. But if the price goes from 176 to 178 between now and then, you'll get that extra percent as kind of like bonus in the value of your stock because you chose the 178 strike and the price actually went up to 178. So even at a third, let's do 1/3%. 1.8. 0.003. Do that 150 times a year. You can still 1.5x your money using a conservative strike. And let's say there's you're in a bullish environment and you're expecting the price to go up a little bit here and there on whatever it is you're trading. You can be less greedy with the premium and be a little bit more greedy about the call away value that you use. So that's about it. If you are looking to maximize the compounding of interest, and you can use IWM or SPY. Can't remember the other ones. Maybe VU. Never traded it, but I would assume they're 3 days a week. Similar to what's happening? Similar to SPY. No, way off. VU is not only not multiples a week, it's like monthly. Okay, had no idea. Obviously, I don't trade VU. I just assumed it was a similar ETF to SPY. So this isn't one that I would trade. Do whatever you want to do. But something like IWM or SPY, you can do covered calls 3 times a week. You keep reinvesting the profits every time to buy more shares, or buy shares of something else and sell covered calls against that. You can take advantage of this compounding interest principle. All right, that's it for today. Be good, y'all.